What you see is not what you get. When headlines scream record profits, most people assume everything is working. They are wrong. What they see is the surface. What they miss is the structure. 7 companies now represent 33% of the entire index. If 7 companies hold up the entire system, you do not have a market. You have a circus tent. And circus tents are fragile, not strong. Fragile. I have watched this pattern for decades. It is not complicated. It is arithmetic. Arithmetic does not negotiate. When too much depends on too little, the system becomes fragile. One bad quarter, one missed expectation, one shift in sentiment, and the whole structure can wobble. That is not prediction. That is physics. Most people think concentration is strength. It is not. Concentration is risk. The numbers tell the story. 7 companies growing earnings at 15%. The other 493 companies growing at 6%. The historical average is 9%. So you have 7 companies growing faster than average and 493 companies growing slower than average. That is not a healthy market. That is a market built on pillars. And when markets rest on pillars, those pillars become too important. If one wobbles, the whole structure feels it. Most people never see this. They see record profits. They see rising markets. They assume everything is fine. They are wrong. The real problem is not the company. The real problem is the incentives. Show me the incentive, and I will show you the outcome. When borrowing is cheap, people take more risk. When risk is cheap, people pay higher prices. When prices are high, expectations must be met. When expectations miss, prices adjust. That is the cycle. The names change. The dates change. The mechanics do not. Cheap money creates speculation. Speculation creates concentration. Concentration creates fragility. That is arithmetic. Simple, brutal, unavoidable. The valuation numbers are telling. The average price to earnings ratio is 29. The historical average is 20. So investors are paying 29 times earnings when they used to pay 20 times earnings. That is a 45% premium. Why are they paying it? Because they expect future growth. They expect these 7 companies to keep growing at 15%. They expect artificial intelligence to transform everything. They expect the future to justify the price. That is not investing. That is hoping. And hope is not a strategy. I made these mistakes when I was young too. I assumed trends would continue. I assumed winning companies would keep winning. I assumed valuations were justified. That is not thinking. That is hoping. And hope is expensive. The speculator thinks the price will keep going up because it has been going up. The investor thinks the price should reflect value regardless of what it has been doing. The speculator is driven by emotion. The investor is driven by arithmetic. Emotion is expensive. Arithmetic is free. Most people cannot tell the difference. They think watching prices is analysis. It is not. It is entertainment. Real analysis is boring. It involves reading financial statements, understanding business models, calculating intrinsic value. Most people do not want to do that. They want excitement. They want quick wins. They want to feel smart. That is why they lose. The system rewards patience. It punishes excitement. Most people choose excitement. That is their mistake. When sentiment shifts, people notice. There was a noticeable shift in market sentiment on December 1st. What does that mean? It means people started paying attention. It means expectations started to realign with reality. It means the feedback loop began to reverse. When everyone is buying the same thing, the price goes up. When the price goes up, people feel smart. When people feel smart, they buy more. That is not investing. That is a feedback loop. And feedback loops break. The cognitive bias is called social proof. If everyone else is doing it, it must be right. That is not logic. That is herd behavior. And herd behavior is expensive. When sentiment shifts, the herd moves. And when the herd moves, prices adjust. That is not a crisis. That is arithmetic. The system is designed to reward owners, not earners, not speculators. Owners don't. When money is created, it flows to asset, not wages. Assets. Oh, the people who own productive businesses win. 1. The people who earn wages lose. The people who own real estate win. The people who rent lose. The people who own stocks win. The people who hold cash lose. That is the architecture. That is why you must become an owner. Not because you want to get rich, because you want to survive. The system destroys savers. It rewards owners. If you save cash, you lose. If you own assets, you win. Most people think working harder will make them wealthy. It will not. Working harder increases your income, but income is not wealth. Wealth is what you own, not what you earn. Most people earn more and spend more. They never build wealth. They just increase their expenses. That is not progress. That is a treadmill. The opportunity cost is enormous. Every dollar you spend is a dollar you cannot own. Every dollar you own compounds. Every dollar you spend disappears. Most people never see this. They think spending is progress. It is not. It is consumption, and consumption is expensive. The people who build wealth understand opportunity cost. They know that every dollar has two paths. It can be spent, or it can be owned. Spending gives immediate pleasure. Owning gives delayed wealth. Most people choose immediate pleasure. That is why they stay poor. The people who build wealth choose delayed wealth. That is why they get rich. The difference is not intelligence. It is discipline. And discipline is free. But most people do not have it. That is the inversion. Instead of asking how to earn more, ask how to own more. Instead of asking how to spend less, ask what you can own instead. Most people never calculate this. They just spend, and they wonder why they cannot get ahead. The answer is simple. They are consuming their future. They are spending their wealth before they build it. The math of compounding is simple. If you own something that grows at 10% per year, it doubles in about 7 years. If you own something that decays at 5% per year, it halves in about 14 years. One compounds, one melts. The difference is not small. Over 30 years, the compounder becomes 10 times larger. The melter becomes 1/4 of its original size. That is the gap. That is why owners win and savers lose. The system is designed this way, not by accident, by design. When money is created, it must go somewhere. It goes to asset, not wages. Assets. The people who own assets see their wealth compound. The people who hold cash see their wealth decay. That is not opinion. That is arithmetic. Most people think saving cash is safe. It is not. It is guaranteed loss. They think owning assets is risky. It is not. It is necessary. The real risk is holding cash when the system is fragile. That risk is unavoidable. That risk is fatal. The risk of owning productive assets is manageable. That risk is necessary. The question is not whether you will take risk. The question is which risk you will take. The risk of compounding or the risk of decay. One builds wealth. One destroys it. The choice is yours. But the math is clear. Well, when markets rest on few pillars, those pillars become targets. Everyone watches them. Everyone depends on them. Everyone expects them to perform. When they do not perform, people notice. Sentiment shifts. Prices adjust. That is not a crisis. That is arithmetic. Some people get rich. Most people get poor. The difference is not intelligence. It is what you own. Own productive assets. Own businesses with pricing power. Own real estate with rent escalation. Own things that compound. Own things that float when the system wobbles. Do not own cash. Do not own things that depend on momentum. Do not own things that require constant growth to justify their price. That is not investment advice. That is arithmetic. When the system is fragile, the prepared survive. The unprepared get hurt. Preparation is ownership. Own productive assets before sentiment shifts. That is how you survive. Most people never prepare. They wait until sentiment shifts. Then they panic. Then they sell. Then they lose. That is not preparation. That is reaction. And reaction is expensive. The prepared person owns assets before sentiment shifts. When sentiment shifts, their assets compound. They get richer. The unprepared person holds cash before sentiment shifts. When sentiment shifts, their cash decays. They get poorer. That is the difference. Preparation is ownership. Reaction is destruction. Most people choose reaction. That is why they lose. The system rewards owners. It punishes savers. If you want to win, you must become an owner, not a saver. An owner. That is the inversion. Instead of asking how to save more, ask how to own more. Instead of asking how to protect cash, ask what assets protect you. Instead of asking how to avoid risk, ask what risk you cannot avoid. The risk of holding cash when the system is fragile. That risk is unavoidable. That risk is fatal. The risk of owning productive assets when the system is fragile. That risk is manageable. That risk is necessary. The question is not whether you will take risks. The question is which risk you will take. The risk of owning assets, or the risk of owning cash. One compounds, one melts. The choice is yours. But the math is clear. You do not need brilliance. You need fewer unforced errors. You do not need to predict the future. You need to own the right assets. You do not need to time the market. You need to own productive businesses. Avoiding stupidity beats predicting brilliance. Most people will never understand this. They will hold cash. They will watch it decay. They will wonder why they cannot get ahead. The answer is they are on the wrong side of the equation. Change sides. Own assets, not cash. Assets. The world rewards ownership, discipline, and avoiding stupidity. Everything else